What if I was to tell you that there's a way to cut years off your mortgage payment and pay hundreds of thousands of dollars less in interest over the life of the loan by doing something so simple you probably don't even realize it? Hey, what's up y'all? It's Shawn, your Charleston realtor. Now I know you might be thinking that this is a clickbait video with a clickbait title, but I promise you that this is probably gonna blow your mind, just like my mind was blown when I first heard about this. And it makes so much sense too. And really quickly, if you find value in this video, it would mean so much to me if you could like and subscribe. And let's get to it. First, we need to define what amortization is. Bankrate.com defines amortization as the process of repayment of debt through periodic installments over a period of time. Made simple, this is your principal and the interest of your mortgage payment each month, and that will not change for the life of the loan. For the sake of being succinct, I'm going to say the principal and interest portion of the monthly payment, and I'm just going to say that interchangeably with monthly payment for the sake of this video. But in reality, amortization is that the bank is going to get paid first. Amortization is the reason why so much more interest than principal is paid at the beginning years of your loan. The amortization schedule for your loan is a basic calculation that is readily available online. But what happens if you don't follow the amortization schedule and instead pay more in principal in the beginning of the loan? That's actually where things start to break down in your favor. Now first, this wouldn't be a Shawn Realtor video if I didn't add some disclaimers. While I am an MBA with some financial background, I am not a loan officer, so don't take this as loan advice. I am merely explaining college level finance in layman's terms. Second, I'm going to add that paying off your home early isn't for everyone. In fact, I personally don't do it, but that's just my personal view on my own finances. To be honest, it's a decision you need to make for yourself. Do you subscribe to the Dave Ramsey mindset where all forms of debt are evil and should be paid down as soon as possible? Or do you subscribe to the Robert Kiyosaki mindset where debt is the best thing since sliced bread? I fall squarely in the Kiyosaki camp, but I know some great people who fall in the Ramsey camp. It's all about your goals, how fast you want to grow and build wealth, and your own comfort level. So here's how to save money over the life of your loan. When you buy a house, put a down payment as low as the loan program allows you to. Then immediately after closing, put the remainder of that money that you would have otherwise put down on the house towards the principal of the loan. By doing this, you will disrupt the amortization schedule and begin paying less interest and more principal through each monthly payment. I think that this hack is best outlined through a simple example. So let's say you're gonna go buy a $400,000 house and you want to put 20% down. Well, a conventional loan will require you to put 5% down. So you really have two options. Option one is you put 5% down, so your total loan is $380,000, and then you put another $60,000 or 15% down after closing, like the month after closing. Option two is you just put 20% down. So your total loan is $320,000 at the very start. Let's assume you're gonna get a 30-year fixed rate mortgage and the interest rate is hypothetically 5%. Regardless, you are going to put 20% down because you want to avoid mortgage insurance and you want to have a smaller loan amount. So a basic mortgage calculator says that option one, where you put 5% down, will result in about a monthly payment of $2,040 per month. However, the month after closing, you put that extra $60,000 or 15% down. By doing this, you just cut your mortgage short by 8 years. So now you pay it off in 22 years, not 30. Assuming for the remainder of your loan, you just pay the monthly payment and nothing more, nothing less. Another interesting fact about this is that over the life of the loan, you will also pay $200,000 of interest. That's an important number, we'll come back to it. Let's contrast that with option two, where you put $80,000 or 20% down at closing. Now, an advantage of putting 20% down is your monthly payment for the life of the loan will be less than if you were to go with option one. In fact, it will be about $320 less at $1,720 per month. However, assuming you make no additional payments toward principal, the loan will be paid off in 30 years by going this route. You will also pay $298,000 in interest, which is about $100,000 more than in option one. So to recap, if you break up your 20% down payment into the 5% at closing and 15% immediately after closing, then you cut your loan short by over 8 years and save about $100,000 of interest over the life of the loan. And also, with either option one or two, you're probably going to avoid mortgage insurance, depending on the loan product, because you will have 20% equity stake in the property. So from that perspective, it doesn't even matter. So let's talk about when this makes sense for you to do, assuming you are already planning on putting 20% or more down already. The debate on whether or not you should put more or less down is not the point of this video. So for one, you would need to be able to afford the elevated monthly payment. Some people might not be comfortable with a higher monthly bill, and that's totally fine. Also, depending on your debt to income ratio, your lender might tell you that you actually need to put more down up front in order to afford the house to begin with. But if you can swing that elevated monthly payment, then go for it. Keep in mind that this strategy pans out in the long term, not the short term. So it usually makes sense to do this only if you plan on being the house for a decent period of time, probably over 10 years, and you have an interest rate such that you don't feel like you will refinance anytime soon. But let's also talk about when the strategy doesn't make sense. If you plan on being in the house for just a few years, then you wouldn't realize much of the savings. Also, if the elevated monthly payment makes you feel uncomfortable, then you might consider putting more money down up front. But let me leave you with a lofty thought that goes against the Dave Ramsey debt is bad mindset. Keep in mind that primary home mortgages in the United States are usually the cheapest loans you can ever possibly get. You can leverage that debt to make more money. I think the easiest way to explain this is to go back to our example in the video. You have a $400,000 house where you can pay 5% or 20%. Those are your two options. That's a difference between $20,000 and an $80,000 down payment. Remember, the difference is a $320 a month payment at a 5% interest rate, though that number would be less at a lower interest rate. Let's also tack on another $180 per month for mortgage insurance. So now we're at $500 per month for the payment difference, which is essentially $6,000 per year. Essentially, you will save $6,000 per year by putting $6,000 down. This is effectively a 10% return on your money. If you were to invest that in the stock market, it's likely you can get a similar or greater annualized return. The difference is that your money remains liquid through the entire time, and now you have the flexibility to do what you want. Maybe after a year, you end up putting $66,000 towards the principal. The point is, the choice is now yours, and the money is not locked up in your home's equity. So what do you guys think? Should you pay a larger down payment, or should you pay the bulk of your down payment immediately after closing? Let me know your thoughts, any questions you have or concerns you have about this strategy down in the comments below, and I'll see you in the next video.